Hey, everybody, we are going to talk about everyone's favorite topic, interest rates. Specifically, good news for a change. It looks like interest rates might come down a little bit quicker than expected, at least if you believe what the market's telling us. I'm going to dive into what investors need to know. Before we do, please take a minute and check out the link you see on your screen, fool.com/Frankel. Get the top 10 stocks to buy right now from the Motley Fool. They are the sponsor of this video and the best way to support this work we're doing on YouTube. Again, fool.com/Frankel, and I'll put that in the description of the video. So I want to go ahead and share my screen. This is a tool. It is called the CME Group's FedWatch tool. I'm going to put that right there. And I know this is all small print, so I'm going to kind of explain what this is and how to use it. So when you look at the CME Group's FedWatch tool, if you just Google CME FedWatch and you'll find this, there are a couple things to notice. So across the top here, you'll see various dates. These are the dates of upcoming Federal Reserve meetings. So the next one concludes on March 19th. Then you have May 7th, June 18th, and it is all the way through the one in December of 2026. So down here, you have the different federal funds rate target ranges. So the current interest rate is 4.25% to 4.5% on the federal funds rate. That's what this is. And these bars represent the percentage chance of each interest rate after that meeting based on what is being priced into financial markets right now. So, for example, in this case, for March 2025, it's telling us there is a 93% chance that the Federal Reserve will leave interest rates where it is. And if you scroll down under there, there's a little chart that says current. So if you're not sure what it is right now, it'll clarify where we are. And just a 7% chance that there will be a rate cut. But if we go forward, say, a couple meetings, and I'll talk more about this in a second, it tells us a different story. It's telling us that there is only about a 15% chance that rates are going to remain where they are right now, and a 50% chance that we're going to see a rate cut by June, and a significant chance we're going to see more than one. So those probabilities have changed significantly in the past few days. We're starting to see a lot softer economic data. We've seen the jobs report really, not look like what a lot of experts thought it was going to look like. We're seeing the effect of tariffs and what that could do to the economy. We're just seeing kind of generally not great economic data, and the stock market's not doing well, and the 10-year Treasury rate's falling, which is usually a good indicator that conditions aren't moving in the best direction. So what that means for everyone listening, I'm going to share my screen, share the slideshow real quick. So expectations for lower interest rates, they can have big implications for both the stock market and the economy. Bank stocks and real estate stocks are two very rate sensitive areas. In the case of banks, higher interest rates mean higher deposits, lower interest rates mean lower deposits. So right now, banks have relatively high deposit costs. That could change as rates come down, and lower interest rates just generally increase consumer demand for loans and things like that. Real estate stocks, not only do real estate companies rely on borrowed money to acquire properties, which is more expensive as rates rise, but higher interest rates generally causes consumer real estate values or commercial real estate values to decline. So those are some stocks that could really benefit. Consumer spending in general is, helped by lower interest rates. Consumers are willing to take on more debt. They're willing to tap into their home equity, things like that if interest rates are low. And just generally, dividend stocks tend to do better when rates start to fall, as do pretty much any interest-bearing investments. So here's what the FedWatch tool that I just put on the screen is telling us right now. So the expectation remains the same. There's not going to be a rate cut in March. That's pretty much priced into the market at this point. It would be a big surprise if the Federal Reserve decided to cut rates in a couple weeks at the March meeting. Currently, there's a 91% probability of no rate cut, and that chart is updated on the CME FedWatch tool, is updated in real time. So I think that's even a little different from what I just showed you, because I made the slideshow about an hour ago. But this is down from 96% a week ago. So, expectations are softening a little bit. When we go out, so here's May. So the big headline is now rate cuts are now expected to resume in May, and that is a big change. So a month ago, the probability, and the Fed generally cuts rates in 25 basis point increments or a quarter percentage point. So this is the probability that we will see a cut of 25 basis points or more by the May Fed meeting. So a month ago, the probability was about 39%. A week ago, it had dropped to 28%. Inflation was a little strong, things like that. But now there is a 53% chance priced into the market that we will see a rate cut, at least one, by the time the Fed concludes its May meeting. So that's a big, big swing. There is now a probability of the probability of 4 or more rate cuts in 2025, meaning a full percentage point or more throughout this year, has increased dramatically. A month ago, the probability of 1% or more reduction in the federal funds rate was just about 7%. That had increased to about 16% a week ago. And now, as I'm recording this on March 6th, that probability is over 41% that we're going to see 4 or more rate cuts this year. Remember, the expectation coming into this year was for 1, maybe 2 rate cuts in 2025. So the expectations for interest rates have come down considerably. So here's just kind of a rundown of all the median expectations. And this is just what's being priced into the market right now. There's no guarantee. This isn't what the Fed is thinking. It's worth clarifying that. This is just where investors see it happening. So they're expecting the first rate cut to happen in May, the second rate cut to happen in July, 3 rate cuts in total at least by October, and a total of 4 by the end of the year. So this is the median expectation. This is the outcome that has the highest probability. And interestingly, 4 rate cuts are also the median expectation for the end of 2026, meaning that there are no further rate cuts beyond 2025 currently priced into the market. Not surprising given the uncertainty level of the market right now, but definitely an interesting thing to keep note of. Like I said, no one has a crystal ball like the one you see on the screen right there that tells us exactly what the Fed is going to do. But it looks like there is interest rate expectations are softening. The Fed is absolutely taking note of all this economic data that's been coming out. And we'll have to see what happens, but this could be good news for bank and real estate stocks and just consumers in general by the end of 2025. I'd love to know what you think. Leave me any comments you might have. I'll do my best to respond to any of them individually. And stay tuned right now for a message from my sponsor, The Motley Fool. Thanks so much. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investments. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market more than 5 times. Go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 914% as of January 7th, 2025, and are measured against the S&P 500 returns of 174% as of January 7th, 2025.